Happy Saturday. Happy after Thanksgiving Saturday. Happy after Black Friday Saturday. I hope everybody had a wonderful Thanksgiving, wonderful, actually, the relaxing day. Again, for me, it's the spirit of being with the family and the friends, which are uh, actually living in this country for 40, almost 43, 44 years now. I mean, my friends are my family, so I'm blessed with that. So, and I'm grateful for having you. Thank you again for another session of our market analysis. And what a way to end the week. Historically, the Black Friday is supposed to be a relaxing day. Most people not thinking about trading, and basically hopefully they're thinking about what is on sale. But it seems like that was far away from everybody's thoughts on Friday. So basically, as you recall, we've had this new variant, Hornicom, or it's a new virus in South Africa, which we'll discuss a little bit. Again, it's unknown at this time, so I don't want to beat the drums too much on it because I don't know a lot. All I know is how the reaction is, and it tells us how the markets are fragile in some ways, and still the COVID story is with us. If you recall, on last weekend's market analysis, that's what we talked about this past week. Besides the Thanksgiving, what we wanted to make sure things are going to go smoothly, there were two areas. Number one was the nomination of the Fed chair, Jerome Powell. We had not heard by Friday, so the markets were kind of antsy, and basically we were hoping that that would be something that would be resolved. And the second thing was still what was happening in Europe with the coronavirus. As I mentioned, my daughter was supposed to go to Paris actually on Wednesday, and then they could not go because of the regulations and with what the COVID was. So she postponed that. So those were the two keys. Here comes Friday or Thursday evenings, and we come up with this new variant. So you can see how the markets are dependent on that. And we will discuss that a little further as far as the markets go. So this week, what I'm gonna spend a lot of time will be on the markets itself. As you know, basically what is happening, the markets, when they go down, majority of time, I'm talking about the indexes, especially S&P 500, it takes almost 90% of the stocks with it. So the more aware of where the markets are, and the more familiar we are with the direction of the markets, the easier it is to do your individual stocks analysis. So that's what we spend a lot of time on, the big picture, and that's what I think I'm going to do this week. So the economy, there's a lot of events coming up this week. We will review that. But as I mentioned, I will spend more time on the markets. A few lessons of the week. I hope you will find it interesting with what was happening this week. The trade of the week, I had a couple of trades that I thought would be interesting. We did not have the gold trade because of Thursday, it was closed, but the trade of the week, I hope you will find it interesting. And of course, we talk about there's still some earnings coming up, and as well as basically the squeeze candidates. So with that in mind, well, let's go over the economy. Now, this week, again, Thursday was closed, so we don't have the updated numbers for the under the hood, but I thought this would be, once in a while, we visit this COVID-19 tracker and see the effects of it in the economy, but also it's the population. What is happening with the number of deaths, the causes of deaths in the past year, and where they rank as far as the causing. And the reason I want to do this, again, this is pre what has happened with this new virus. Based on that, we know it is transmitted much faster. And again, there's a lot of unknowns. So As you recall, I know a lot of you on top of it, like US has closed its, borders as far as entries from most of the South African countries, from Botswana to Zimbabwe, and of course, South Africa. There have been cases in South Korea, in Hong Kong, in Belgium, and I believe it was this morning that the UK has had a few cases as well. So it is that unknown. And because of that unknown, that's what the markets react. And there's an old saying, the markets, they sell first and then they ask for questions later. So we will, when we talk about the markets, we talk about it more. The reason I want to share this with you, so we can have maybe a visit a few weeks from now to see how much development has there been. So again, this is for your records. As I mentioned, we're also looking at as far as the Pfizer and Moderna and Johnson and Johnson dosages. Would that, because of this, would that be the people who were on the sideline, they were hesitant? Would they kind of be as far as motivation, would they be motivated to do it? So that's the food for thought. The second thing is we have a pretty active month, beginning of the month coming up. As you know, Tuesday is the last day of November, and historically the Santa Claus rally has started, really Black Friday. Now we have the Cyber Monday, for instance, on Monday. So what happens is a lot of earnings have been done. So now the focus going back to the economy. And of course, right now, the focus is on the COVID and the variant. So what we will see basically on Monday, and that the Fed Chair Powell, he will be busy because he's going to be talking with the Congress. He's going to testify. Again, he was, if you recall, Monday, we will look at the markets. Monday morning, you woke up and you noticed that Chairman Powell was renominated. So there was a relief in the markets, but also some reactions. And that's what we will review, some of how the different markets reacted to this nomination last week. But as I mentioned, everything went secondary on Friday because of what happened overnight with that South African and Botswana virus. Now on Tuesday, as I mentioned, the chair, Chairman Powell testifies, but also we have to watch the PMI. So we want to look at the inflation numbers and also the Purchasing Managers Index. We want to see what is the growth, and that will give us a little more direction as far as the economy's growth. Wednesday, again, we look at the ISM, and Institute of Supply Management comes with their manufacturing side of the producers market index, and the Fed chair again is testifying. Treasury Secretary Yellen speaking. And then Thursday, this is interesting because the oil has been on the forefront of the news as well. So OPEC is meeting. Now, Iran has already declared that they want to go full, they want to go to production President Trump's production. So we shall see what's going to happen there. And then Friday is a very important day. It's the first Friday of the month, and usually, and most of the time, 11, 12, the first Friday of the month is when we get the unemployment numbers, the non-farm payroll. It's at 5:30, so watch for that. That's an important time and date, and we want to follow that. I also want to see what is happening with the average hourly earnings, right? So these are some of the big ones. So the last thing on economics, since we had the COVID, I just thought this is an interesting chart I wanted to share with you is, the baby boomers have started retiring, and, the people born from 1946 to 1964. So this red line is the normalized what has happened last 10 years. So the rate of the retirement and the percentage of the people who retired. Now, interesting fact is this blue line is what is happening since last 20 months or 18 months. And so the COVID has become an excuse for even faster retirement. So there are more baby boomers are actually retiring. So you see this big jump. So that became an excuse. So this is important factor as far as the consumption, as far as the, again, the behavior of investments. They have 401ks, they have different asset class investments. So with the very low yields, how would that affect as far as the asset allocation? So, but also, again, we are in a healthcare, I don't want to say crisis, but environment that it's affecting people's decisions. So that's as much as I think economy I want to talk about. Let's move into the markets. So as you know, as I always start with the sentiment, and there is a reason for that, is because as a human psychology and emotions drives the markets, although there's a lot of fundamentals involved and look at the technicals, but even technical analysis is really human psychology. So every week, as you notice, I do 3 different sentiments, and one of them is the American Association Individual Investors. The interesting part about this is you see that the variability from week to week. And remember, this comes out on Wednesday. So by midnight of Wednesday or 12:01 Thursday, this is published. So it doesn't take into consideration what happened, on Friday. So what is happening now is we went from 48% on bullishness to 33.8% in just 2 weeks. And we went from 24% in bearishness to 35.7. So what I thought about this week in the lesson of the week, I'm going to dive in more into analyzing what this AAII sentiment stands for. So to understand these numbers better. One common thing, and I'm going to speak about maybe in the next few weeks, we go analyze, for instance, what is the CNN Fear and Greed Index. So we have a better understanding. But there's a common things, I think, in my opinion, is all of these sentiments, when, been around, the markets for 36, this is my 37th year, because of the so much availability of the informations, I think these sentiments have become more volatile, these readings, because we have access to so much. And you can see how the variability of a week ago, we were at 69 and there was greed. All of a sudden, after a week, we are now at 31, the fear. So that's one part of the aspect of, in my opinion, of these sentiments being sometimes being a little noise and losing in a way, in a long term, having that as far as the going counter to the herd mentality is lost, because in the past we used to do a lot of fundamental analysis. The feeling was, long-term investing, and now with the entrance of a lot of new traders, the markets have become really more of a short-term trading. So emotions are a lot more involved. As a matter of fact, I have to say, like the Turkey Day, yeah, we talked about people at home, and I mentioned Friday, most of people will not go, back to work. They're going to relax. But since the pandemics have started, even before that, if you call a lot of the younger generation with the Robinhood effect of Robinhood, everybody had their laptops, they started trading. And what happened is after pandemics, now everybody has their trading account, their investment account, they have their laptop. So they're at home. So you will see one of the reasons we had such a large volume yesterday, and it was a short day, by the way, because the markets closed at 10 o'clock, the cash market. The reason is there's so much more availability for retail investors. So I think that's why, at least in my opinion, there's not academic studies on this. That's what I think you see much more variability from week to week. So in some ways, when we talk about lesson of the week, we're going to look at the more of a long term. This study was done. Even in a short term, it could be, uh, as far as the messaging goes, is more of maybe the extremes in the short term, but not a long term. Remember, like for instance, the fear and greed or the AI sentiment, they look at for like 6 months from now, what do you think what's going to happen with the markets, what's going to happen? So with that 6 month outlook, day to day, we're getting more affected. One day we are all, euphoric and say, oh, the market's going to go up, everything is good. And then within the day, everything changes. So keep that in mind. We will discuss that a little more. So that was important. So here's what we had for the week. Nothing positive, as you can see. Everything dropped. Well, thanks to Friday. It was one of the largest drops we've had. This was this year. So basically, the only one which the least affected was the utilities, which is the defensive sector, and also because of Friday, the movement to the bond market, the interest rates going down. So obviously it helps the utility because of that, and also being defensive. So the biggest loser were the small caps, as you can see, 4.15%, and then the technology, which was NASDAQ. Now, to begin with, last week, we already had a negative breath. It was 1 to 2.5. So we've had this underlining, the soldiers have been going down, or there was more negativeness, and this week we had 815 to 2700. So the underlining, there has been the weakness, and we will look at the charts and look at it a little more in details. Now, the dollar, once you see here, is dollar had been strong. We had broken out of our resistance, and it looks like flat. But Friday, something happened to dollar. So the weakness came in, and we want to discuss why. What happened to dollar? Now, the bond markets were stronger. And again, this is mostly because of the Friday, and like what happened on Monday with Chairman Powell coming into the picture, the tapering, then the rates started going up, and then thinking that, well, would we have two? Well, initially it's like one is given. Will we have two, even three? And would the tapering go faster than, if it's 15 and then we're going to go to 30, and it's going to be faster than that? And what's going to happen with the tightening? The crude oil was a big story. Again, it was underlying, there were things going on, but then Friday was a big catalyst, or I should say Thursday evening. And then the inflation, consequently, it was pretty much down, but because of, mostly in this situation, was the energy and the precious metals, because the gold also broke down. So just a picture of that, the week. You can see a lot of red. And Friday, I just went back, it was, I would call it like a toilet paper trade, and basically staying at home. There was this panic. So when we go, you can see for the week, you have Procter & Gamble, for instance, up, Walmart, Costco, Dollar General. And then, of course, there's a lot of healthcares on Friday, actually. They were up because of, again, the concerns. Peloton was up on Friday, which, again, Netflix. So a lot of these people have these memories. They do remember when the pandemic happened. They're thinking, oh, these are the stocks that went up. I missed the opportunity. I'm going to jump into that. So the question you have to ask yourself is, how much do we know? Was this overreaction on Friday? And would we continue with the sell-off? And what's going to happen on Monday? So what I decided to do, I'm going to look at a lot of different charts, but these are my feelings as far as historical, again, experience that I have historically after the usually Turkey Day, the Black Friday is usually, again, it's a very quiet day, And the day before Turkey Day, the markets go up. The day after Turkey Day, actually, it goes down a little bit. But Mondays are usually, historically, have been strong after the Turkey Day or Thanksgiving Day. Sorry about Turkey Day. Thanksgiving Day weekend. So again, it's a Monday, it's a Cyber Monday. And so if I were you, what I would do is everything is going to happen Sunday evening because all the news are coming out. They're coming fast. Again, there's going to be more cases. It is going to be very much related to COVID. So what is happening is I would be on the sideline and I would watch Sunday evening. So Monday comes, and that's why I don't like the Monday's trades, because I want to watch what's going on. Historically, if you notice, a lot of big crashes have happened on Mondays, and the Friday sell-offs are not a good omen for Mondays. And this was very unusual. Remember, this was a half a day, and it was supposed to be a very low half a day. And yet, you look at look at this volume. This was for half a day in cash and SPY. So there was a lot of volume, as I mentioned. Mostly, it was a lot of retail investors being home. There is that fear. Again, they want to get out of the markets, but also because of the sell-off, you will have margin calls come in. So Friday's margin calls are the worst. Tuesday, you have that overnight. The Wednesday, you have the Thursday, Friday. But when you have it on Friday, you have 2 more days. So there's this panic. And that's why all of a sudden, it's Sunday. I'm an investor. I've had a margin. I bought some holdings on a margin. And now I see, oh my God, things are going down. What's going to happen on Monday? So that's why the exasperation of when the markets go down, there's more margin calls, so they just push it even lower. So in my opinion, I would be just observant on Monday. Now, there's a couple of things we can see, whether it was overdone, and based on charts, we will evaluate that, and that would provide some, buying opportunities, or this is the beginning of something bigger. And again, seasonality wise, we are in a positive side, right? So, and I still see there is no, with especially the rates going down, there's no other alternatives. And when we look at basically, when we look at the whole situation, we see there was really only 2 places, main places that the money went for security. It was treasuries, that was one. And basically VIX was the big one, which we'll review that, how VIX was up over 50%. And other than that, the Japanese yen was basically because of the weakness in the dollar. And other than that, even gold was up overnight, and then that fizzled. So gold wasn't, even though after hours it did come back up, but so even gold was not a holder. We've been hearing about Bitcoin, the alternative, the digital currencies. Oh, Bitcoin is the new gold, for instance. You see what happened to Bitcoin. We will review it, actually. You might not know, but it had a big sell-off as well. So really money had no place to go. Now, if that's the case, and we still don't have any places to go, and the rates maybe stabilize or come back, then you might see the rebound. But I think Sunday night is a very crucial time. I would watch the markets. If I were you, not to do anything. As I discussed it with you in the trade of the week, these are the times you want to be on the sideline. You don't want to be a hero. Let's get some certainty. So I would be more maybe a investor trader on Tuesday. So this is, I thought, this is the elders indicator, or the, we use it for the chart type, which he combines the 13 EMA with the MACD. And so for SPY, combining with RSI and the MACD, when it's blue, that's neutral. And those are the times that, you want to be on the sideline, or you want to lighten up a little bit. You would not be a buyer. And the red is when the MACD has already gone down, and then we are below the 13 EMA. So we got a red bar from this. So we leave it at that. We will watch. It's the important part in all of these analysis. You will see that 50-day moving average becomes a crucial support. I've been sharing this slide, I think, for the last 3 weeks or so. And basically, what we did, we went from the high of the September 2nd, before the Labor Day weekend, to the low of beginning of October, using Fibonacci. And basically, we wanted to use the extension. And every time we hit that 161.8%, we've been rejected. And finally, we tried it, believe it or not, even Friday, that's when everything came crashing down. We broke below the 8, have broken below the 21. And now I go back to that 50-day moving average. So we want to see if there's any chance we can go down there and bounce back. Now, the question is, I would say about 4,500 area. We have this 4536. Basically, we want to, I would say that 4,500 area, like this zone is a very important zone. So we want to see if this area will hold. And if it does, like past events, every time we've come close to that 50-day moving average, we've bounced back. But this is a huge candle, so with a big volume on a half a day. So that's what I said. I need some certainty or clarity. I shouldn't say certainty, clarity on Sunday night and Monday. The other thing is I do watch 60 Minutes, and you can see this is the overnight after the Thanksgiving Day. You can see the news came, and I really like the moving averages on 60-day as well, the daily. And you could see this is I use the 8 and 20-day or 20 bar moving average. And here, once we broke down, and that 4706, 03 was our support area. Once we broke through that and the moving averages crossed, we could never really, it was like a waterfall. Now, the interesting thing is, this is where our markets open, and that was this big gap. So basically, that's what happened. Remember, the cash market was closed on Thursday, so you did have a gap, but the gap happened overnight, and we tried to go break above the 20 bar on the 60 minutes. We could not. And then you can see this huge volume came at the end of the day, and there was some market on close, and a lot of retailer may be looking for basically a reversal on Monday, but that was rejected, and we closed at the low of the day, and that's where we stand right now. Looking at from the point of view of Ichimoku clouds, we looked at, so this is the S&P cash. Again, I have my Fibonacci drawn. You can see in S&P cash, that was the futures. We still, you see how big of a resistance that was. And we closed below the trend line and standard line. So this is the support we are looking at. We are above the cloud. The question is, this cloud is very thin. So the thinner it is, the less the validity, in a sense, easy to cut through. Thick ones are obviously, takes more time to break through. We're still in a positive trend. The DMI is crossing the DMI positive, some DMI negative. But as I mentioned, this could be overreaction, or it could be beginning of something. So we want to watch this, again, Monday. So come back to the Bollinger Bands. Now, the Bollinger Bands, we've been discussing it last few weeks. We could see that what happened, I believe last week we discussed it, the divergence from stochastics, MACD, even in RSI, I don't have it here, but we could see that the markets were, telling us, although we were hitting the highs, the markets were not, that the momentum was not there. we stayed above, we touched that 18-day moving average, and then finally we broke. Now, the question is, we are oversold. Again, we watch Monday. Are we going to bounce back? We are outside the Bollinger Band. So will we come inside? Will we have a, there's two scenarios. Will we have a big capitulation and then have a reversal? Or are we going to have a big buyers coming in, you know, that by the dip, and then if that fails, will we have the second leg down on Tuesday or Wednesday? So that's what we need to watch. But this is the support right here, the 100-day moving average. On a weekly basis, though, we still, you know, embedded. Although the MACD is pretty flat, we did go outside the Bollinger, it came back in. So we go back to, again, our 18-week moving average. And every time we see that, that 4,500 area becomes crucial. So we want to watch that first at 4,500 area, see if we can bounce from that, or if we can reach it, then see what happens. I think that we'll put that a note in there. One word of caution is this big candle on a weekly basis, we engulfed and actually went low. So we went to low of the high bar last week. We were the high bar, so we closed below that. So that's a warning sign in the short term as far as the candlestick charting. So this is on a weekly basis. So let's watch that. The story goes with the Nasdaq, the same thing. Nasdaq had been, you know, it was strong because of the mega caps. You know, think about the Tesla. As a matter of fact, it was really interesting on Friday, Amazon, beginning of the day, if you notice, again, this was more of a shopping day, and talking about, again, more of a supply purchasing day. Amazon was up nicely, Home Depot, Costco, and then they all fizzled toward the end of the day. But this is Nasdaq. That's 161.8. We tried it, we failed, and now we are in a 127.2 and also the standard line. So we shall see what happens here. Again, you can see the cloud is pretty thin. So we don't want to break below this. Now, one of the things, I think one of the lessons I had shared with you with these turning lines and standard lines, which are the 9 and 26, basically what we look at is there are times that we break below the turning line. And if we break below the standard line and snap back, that's a very bullish signal. So what I mean by that, let's say Monday we had a big drop and then we bounced back, then that usually goes back to previous high. But if we gradually just go below this, then our next, I have this support line, but eventually we'll go to the top of the cloud. So we want to watch, again, that's why I keep saying Monday, Sunday night, Monday, let's watch what's happening in the futures market. So we are right in the support, so we want to watch that. But as I mentioned, we call that, it's like a sling trade. It's like, you know, how to use the sling. It's like a snapback. So let's see what happens on Sunday evening. The same story with Nasdaq. You can see we went last week, Monday, we went outside the Bollinger Band. We came back, we closed on Friday, we closed below the 18-day moving average. Now the volatility is narrowing, which is really interesting, but let's see what happens on Monday. So we are oversold, and the MACD has crossed, and again you can see the divergence on both stochastics and the MACD. On a weekly basis, similar to S&P, we're a little farther than S&P on 18 weeks, and we are embedded. So there's been a, you know, indecision basically on the MACD, although we are the trend still on the positive side. Now, the small caps have been the biggest, really, as far as biggest affected. We had a breakout, which was right around here, and looks like maybe it was a false breakout. but I mean, we had on a weekly basis, I was looking at. So we did have the breakout, and look what happened. We are back below where the breakout had happened. So I'm using it as the Elders indicator. Green, green, we go to neutral, and then at 237.50, we've been red, red, and we are right. Again, you can see we broke below the 50, and we have broken the 200. This is crucial because we want to, again, in a high volume, we've done it in the past. Every time we've closed below that, we've come back above it. So this is also important, watching again next beginning of the week. The same thing on the Ichimoku on a daily. We broke above, again, that was a breakout from the Ichimoku point of view, 161.8. This created almost like an evening star. We go up and then we just gap down and closed below that 161.8. And since then, we have been just going down below the turning line, below the standard line. And right now we have found the support above the cloud. As a matter of fact, we are right now, this zone is the ambush zone from the, again, the September previous recent highs, in a sense, which I'm using the same thing I did with the S&P, the time-wise. So I went from September high to October low, and or September low before the October low happened in the S&P. But you can see we did we bounced back below the base of the cloud, and this area right now is at that 50 to 61.8%. So just a food for thought. Again, on a long-term basis, we are actually below on a 100-day moving average. So we want to watch that. We have become embedded. So let's watch this. This is important on Russell. And on a weekly basis, again, we just broke below the 18-week moving average. Momentum is going down. We're still above the 50 point. So still not 100% has become complete collapse. So we watch this. And the Dow Jones, the same thing. I mean, you can see the common theme with all of these, right? So again, the retracement to 161.8 could not break it, and here we have collapsed, and we hit actually the cloud on our YM 100-day. We broke below the 100-day. We are oversold at this moment. So again, every theme takes us back to Sunday night, Monday. The transportation, we finally broke down below that 18-day moving average. I want to spend a little more time on VIX. So VIX was telling us that, okay, we went outside Bollinger, we came back in, which is normal. The markets go up. And then we had this huge move. So this is historically what we've seen. And I've said it before, every time we go outside the Bollinger Band, we actually come back in. And we are at the resistance last time, I think, yeah, it was in May. We had the similar pattern. We went in May, and then end of September, we had the similar pattern. It was a one-day wonders. So watch this VIX. Again, we were up 50%. Now, if you would have done, talked about in the past about the VIX, the volatility spread, I think I was looking, I had done it before, but if I would have done kept up like now, I think this would have been like a 7,000% return if you were doing that spread, because it was like a 10 cents, and I think it went to $5 or $6, something like that. But so the question is, are we going to follow the same pattern, and would the VIX come down, and consequently when the markets are going to go up? So this has been the norm since last 15, 16 months. The only time that this VIX really started flying, obviously, was in March of last year with the pandemics. So it was a COVID related. That's the question. Again, that's what I want to watch on Sunday evening, but mostly on Monday, see how this VIX is going to behave. I will discuss this a little further with the options as far as the VIX, where do we stand? And the VVIX, if you recall last week, that 110 area, somewhere around that area, we were saying that, markets are in all-time highs, but the volatility of VIX is not really dropping that much. So we were just flirting with that 110 area. And here we are at 150, for instance, on the VVIX. So this is another tell sign that markets were tired and the volatility is still there. But even with VVIX, you see every time we go outside the Bollinger Band, the volatility collapses. So let's watch that. And of course, the story was about the interest rates. And what happened is the flight to quality. One thing I have to clarify is why the bonds are the recipient when things go down. So if I sold, let's say I'm a portfolio manager, I'm an institutional manager, and I sell my holdings. Now, most of the time, that money goes to cash as far as if you were individuals. But with the portfolio managers, it's a very difficult job to keep that money or move it to cash. So that's why we have the movement allocation of funds. When there's a selling on one asset, that asset moves to another asset class. So what happens, if I sold some stocks, that money doesn't go sit in cash. Basically, again, depending on the investment policy statement and whatever we've written based on our guidelines, that money ends up going to another asset class. In this situation, it could be the treasuries. And that's why all of a sudden you see it's not just because of security, but also that money finds another vehicle. And in this situation was, let's say, 10-year note or the 30-year bonds. And the money moved there. And you can see all of a sudden it's a big drop. And here's a 10-year note. We dropped below the 18-day. And the volatility on the rates, it's been very interesting. So here we are. We've been above 18. We are below 18. So the MACD doesn't know what to do. It's pretty flat. So want to watch these basically the same like what is happening with 10-year note. We've been flirting with the lower edge of the Bollinger Band. We are oversold right now. Momentum's trying to move up. MACD's trying to cross. But that was a big day. Again, it was with a short day. So let's see, is it going to go and at least hit the upper edge of the Bollinger Band, the resistance? What's going to happen with this? Because this was the security zone for the investors at that time. The same thing we can see that the 30-year bonds, they behave the same way. And financials, actually, they had a really nice week, especially after the Jerome Powell, the news came, and then we dropped on Friday. So we were above the 18-day, and now we are below. The momentum is down, but financial, we're going to watch the interest rates when it dropped. So you can see we were above the 18-day, and here we are. We're just bouncing off the 100-day moving average. So we want to watch that to find the support. So telling us, well, we've had support at 100-day, most likely maybe the rates are going to go up again. So let's watch that. This was a mystery on the surface, the dollar. So we talked about the risk on, risk off. So the risk was off on Friday. Historically, well, the money goes, so it's the safest place. It could be the bonds, the gold, Japanese yen, maybe. But here, and also the dollar would be the currency of choice. And the dollar had a big drop. And obviously the main culprit, in my opinion, for this was the interest rate. So when the interest rate dropped so much, that affected the dollar. So the dollar didn't become that security, it became the concern. that, the yields are going down. So that's why we had this big drop. Now, the question is, we still in an uptrend, above the 18-day moving average. The slope is up. We are embedded. The MACD is still up. So Tuesday, Monday, by Tuesday, we should know that are we going to turn this around, because I'm looking at the euro. And we talked about, my support was at 112. We went a little bit under that, and then we had a bounce. Now, this bounce is not the confidence in euro, although with this new, again, what's going on, I mean, it was before even with the new variant, we were having shutdowns from Austria, talk about Germany, and other countries. Basically, what is happening, the idea was, wait a minute, the interest rates, we're just going to continue keeping it low as long as we can. So, which didn't bode well for euro. The rate will be lower. So that's why we've had this. But then with the weakness in dollar, that's why we had this jump in euro. But we still embedded. MACD still down. So I think, this could be temporary. It all depends on what the dollar is going to do. So, I mean, if you would have sold short here, the euro would have gotten out of euro at 120. This would have been a nice journey. So basically, my next target will be 108. If we break down, we shall see what's going to happen with with this new COVID situation. Gold. Now, as I mentioned, you would think gold would be the sanctuary. We did have a nice jump above $16, $17, and then we just couldn't hold it. Again, though, after hours, we were up $9. So we want to watch that, see we are in a good support. I believe in the long run, still there's a support for gold, but we needed this, that, we couldn't go anywhere. So we finally just gave up, and in the short term, we are in a downtrend. The silver, the same thing. But the interesting thing is, look what happened to silver. Even after hours, we are down. And I just want to look, gold, that's a gold flat chart, although we are oversold, fine. And then we go to silver, we continue the downtrend, and we're getting close to the support lines that we've had. Now, the silver, as you know, we've talked about it. I keep saying silver is between copper, economy, gold, in a sense, precious metal, more of a hedge, inflation protection. So basically, it's playing in between, and that's the reason silver was more of a like economy sensitive here. And the same thing you can see here we are with the copper, who had a nice bounce. That was a concern, and we became overbought, and then they went down. Bitcoin. So the Bitcoin, the talk has been, as I mentioned, there are the alternative to gold, and yet we had another breakdown on Friday. We are close to the edge of the Bollinger Band. We closed below my 58,000. Yes, the 58,000 support line. So we broke down. We are embedded. So there's weaknesses there. Now this 100-day moving average is becoming support. As much as it's being accepted and all that, still, in my opinion, there is danger in a sense of there's just too much speculation going on, and we need to cleanse that. I mean, people bought Bitcoin here. You could trade them even if you do micro, still there's a big margin requirement. So there has been, we've lost almost $15,000, $14,000 from the top. So be aware of that. So this answers the question of, all right, when there's a crisis, the money is not going to Bitcoin. And here we go with the oil. So what happened with oil? Now, the oil, okay, granted that the governments around the world, they want to use the reserves. President Biden has said, oh, you have to use the reserves. The gas prices will be down. If you live in California, you know what I'm talking about, how expensive it has become with the gas prices. So, but obviously this was basically, again, a COVID play, and the markets just overreact, not that overreact, but they just reacted to the demand side. And when we look at where the biggest losers were, they were all in the leisure and hospitality, Carnival cruise, to airlines, to hotels, and then that affects the demand, obviously. So you can see how much is affected on that Fridays. And that's what I think, again, I would be on the sideline watching Sunday and Monday to see how much clarity will there be. Again, we don't know anything, not much, what Pfizer is doing their work to say if this is going to be effective. They need a few days, and Moderna. So we shall see what's going to happen. But we just broke below the 100-day outside Bollinger Band. As I mentioned, let's see if we're going to snap back or this is going to continue. By the way, with oil, as you know, we just talked about OPEC is meeting Thursday. So that's another thing. Historically, in my, again, experience, the OPEC countries, and and also Russia and other countries, they like that $75, depending on the economy. That's a sweet spot. So 70 to 80, they need that. So we shall see if they're going to try to balance it out and see if we can have it at 70. Otherwise, we are going down to 60 support, and we'll see what's going to happen. Sorry, that's also, this is the energy index. We were doing nicely, and we talked about the rigs last week. So here we actually had a nice candlestick right inside the Bollinger Band. So the momentum is flat, but still going up. So the energy stocks might behave better than actually oil. Quickly over expected move, really interesting what happened with SPX. We had, it was a $54 move expected, I think 56 last week. For this week, it is about $146 to $150 move. So you can see how the volatility has just expanded. So we did go on Friday, we were nicely in the middle, and then Friday we just broke below the lower edge. The same thing with the NASDAQ, the QQQ. We were parked right on the lower edge. We broke below it on Friday. IWM was the biggest mover. Look what has happened since it hit the all-time high. We broke again on Friday, completely 2 standard deviation. And basically the same thing with Dow Jones. We were flat for the week, or a little bit. We broke down on Friday, and the bonds, the opposite story. We came back inside the edge of the lower edge, and we closed right on the upper edge of the expected move. On gold, we just broke down, and that was a big move again, very much related also to the bond markets and the renomination of Chairman Powell. The same thing with silver, outside expected move. The financials, on the other hand, they were actually having a nice week. They had a nice outside expected move, and boom, they come in close to the edge of the lower edge of the expected move, and they finish on the negative for the week. The other party was in the energy, 2 standard deviation outside the expected move. Really great days they had, and then they came down, and they actually stayed positive. They were positive for the week. All right, okay. So let me go quickly over lessons ahead. So a couple of things. Once in a while, if you notice, we're talking about inflation and other things, and then I'd like to use different currencies. rather than just the dollar. So we want to see how is NASDAQ doing compared to gold. And this is our channel. You see we have a channel. And this is where we were in March of 2000. So that was the most expensive at 16. Right now, this is the largest we've been in the past 20 years, since 2000, really 2001 or so. So even though we're still in the uptrend, so just a food for thought, what's happening. Either NASDAQ has to maybe slow down or gold is going to move up. So that doesn't mean we are going to stop going up, but it's just the cautiousness has to be there. So one of them has to do some move. The other thing is, we was going to talk about the real earning yield. So we talk about the 10-year note, we talk about the yields, and we know about the PE ratio, which is the price earnings, price divided by the earnings or net income of the companies. So if we do inverse of that, that would be how much that company or the earnings is yielding us. And obviously that's what we want to compete with, is this a good investment compared, let's say, to treasuries. So basically what we have seen here, this is where we are. And the reason we are in that negative 5% is because of the inflation. So we have a positive earning yield, but because the inflation has been at 6.2% in the last count, we are in a negative 5.2% or so. So basically, whenever things like this happen, we drop. In this case, the markets are expecting next 12 months that the markets will be down 5.2%. Now, if we were at 1%, or these are the projections. So the sweet spot is obviously the very little inflation and a nice value and low price PE, then you could have a great, this is the best scenario. And that's what it tells us as far as where we stand as far as the yields go. So I just thought to explain, earning yield is the earnings divided by the price. PE is the price divided by earnings, and the real earnings is again, we take the inflation into the equation. So, and we are at 6.2%. 1948 and 1980, we were at 14.6% with inflation. And in 1948 to 1949, we had negative 3% in inflation. The other thing I want to discuss this is the VIX. What happened to VIX on Friday? So amazing. Yeah, Friday is a half a day. Just remember that. Our sizzle index was at 2.68, and we had 1.4 million, 4.38 million of contracts just changed hands in the VIX. So we are, at that time, with the average, we're at the 78% IV percentile. So, and this explains, this is how fast things can move. So for the December 1st, we are at 284 percentile. Now, as the time goes by, obviously, you can see it goes down, but in the near term, there is that fear, and that's what how one thing, one event, very much event-driven, can affect the volatility and implied volatility on the volatility index. Okay, so next one is, this is on the AAII that every week we use. So I thought, let me just do a little explanation about how the sentiment has done and how effective it has been. It's the sentiment, right? It's the psychology. So I just thought this is for the past, I think 5 months or so. So let's take a look. And, you can say, oh, September 15th was the lowest. The bullishness was 22.4. Bearishness now about 39.3. And neutral was like 38. So we look at for the extremes. So I just want to give you this past few months, which you can see we've been all over in a sense, 48.6. Then we go to 22. From 22, we jump to 41, 48, and so on. So I wanted to use a study that had been done. This was done actually 8 years ago. So bear with me, because this tells us how effective they have been as far as, do they have any indication of the future of the markets? What happens to the markets basically when times, when the indexes are way above average, or I'm sorry, when the bearishness or bullishness is above what they have average. So let me give you a little history as far as American Association Individual Investors. Now, I personally have been a member of their group since 1990. I've actually spoken in their events. So I can tell you, majority, and based on experience of 31 years been with them, the big chunk of the group that I recall, I remember, they were, majority of them were white males in their 60s. The net worth was over $1 million, and they were very much a fundamental analyst. What I'm saying is, they would buy their holdings and hold it, and they would invest. Basically, they were investors. Now, since then, they have grown, and they do have a very diverse group right now. So they have taken, the age group is probably going down, but it's a very much kind of a retired group. So the reason I want to share this with you is because they do from like Thursday morning to like Wednesday, they call you, and it's a survey. They ask you to participate and say, well, in next 6 months, do you think the markets will be up or they will be down? And basically that's how it works. And the reason I want to share that with you, so that was in the past, it was a little easier because they're long-term investors. They sit back, they're not trading every day. So what they did, it was a little more reliable for long-term. In a short term, on the other hand, now, as I mentioned before, the past 8 years, becoming more technically oriented, there's a lot of times that even though they still, majority of them buy, hold, they are investors, but they are in a lesser degree. So that's why I want to take this with a grain of salt. So this study was done in 2013, 2014, about 7 to 8 years ago. So rather than going to the whole thing, I just want to share these tables with you. Like you can see, the bullish, they found out that the 38.8, based on their studies, which started in 1987, incidentally. They started doing the sentiment analysis in 1987. They have been 38.8. Every week I show you the 30.5 is neutral, and bearish is 30.6, right? So the bullish sentiment is, what we are using is 1 standard deviation, 2 standard deviation, 3 standard deviation. So given 38.8, 1 standard deviation will be 49.3. The 2 standard deviation is 59.8, and 3 standard deviation is 70.3. And if we go the negative, obviously, if you go to 3 standard deviation downside, this is like your expected move, right? So that's what it is. So rather than taking all your time, I'll just give you my conclusion. So you can read this, basically have the same to be bearish 30.6, the 3 will be 60.9, 50.8, and 1 standard deviation is 40.7. What we have found out, and this is just some of the numbers, like for instance, for the neutral was 62% in 1988. But what I'm interested, like the bearish sentiment, which has averaged 30.6. The record high for bearish sentiment was 70.3, March 5th, 2009. Just remember that day. That's about 5 days from the bottom of the financial crisis when S&P hit 666. So that was the high, which was 3 standard deviation. And look at the low. The low was at 6%. This is the bullishness. I mean, the bearishness, sorry. The bearishness, August 21, 1987, exactly 2 months before the October crash. So in order to use this, in my opinion, and I'm sharing this with you, the performance of a 6 months. So if there was a 3 standard deviation, there was only 2 occasions that we went on a bullish sentiment, went to 3 standard deviation. And 1 standard deviation, in fact, when it happened, what was the return? I'm just going to summarize all of this. You have access to this. And again, you can see from 1987 to 2013. So I will be a little, still meaningful for me. But what I've learned over the years, that these sentiments a lot of times are better, and you will see this on a 2 standard deviation on the oversold side, when there's like 2 standard deviation of bearishness or negative 2 standard deviation of bullishness. What I mean by that is, now let's say if the bullishness goes down, like you can see here. So if we've had 2 standard deviation and there were 16 occasions, basically the markets have returned much higher when they were a lot of negativity. So basically that's it. Or when the bearishness, you can see when they were either 1 or 2 standard deviation, there were a lot more negativity. So for a lot of positivity, we are inconclusive. So we can be very greedy. At least in the AAII, what I have found out, it gives you mixed message. But if there's a lot of fear, usually that's a good indication it's time to get in. All right, I hope that's helpful, because I'm going to use that. I mean, next few sessions, maybe we'll talk about like CNN, fear and greed, which is completely different than this. This is more of a sentiment of survey. The other one is actually looks at the 7 factors, which includes some of the sentiment. So I hope that was helpful. This is a summary of, how they started 1987. Some of the dates, what they have done, but I just wanted to give you the real summary of my conclusion. And the bottom line was you have to look at different really things. That's what we try to do. This is one of them. But as I've said it in the last just few weeks, you can see we were greedy and we are scared, so, all right. Let me share a couple of my trades for the past week. I had actually, it's a busy week, few trades. Also had a busy week personally, but this was interesting how the week went. It was a short week. Again, remember the Thursday, when the futures were open, overseas and but the markets were actually closed. So that's why we have 1, 2, 3, 4, which is 3.5 really. But Monday, we did close our gap. These are our gap plays. Tuesday, there was really tiny, nothing to speak of. We stayed within our first hour high. And then the same thing, and Monday, it was interesting that again, our high was made. We could not break through it. Now, this was Wednesday. We had a positive day. The day before Thanksgiving, generally it's positive. And look, we had a gap down. Nicely, we closed it. The low of the day held, which incidentally was the low of the first 60 minutes, which was the low of the previous day. So that held. So that was nice. And then, of course, Friday comes, big gap. And big gap is usually professional gap. So if you even were thinking of using that close of the gap, in many ways you would have avoided it. It's Friday. Fridays are not the great. They're still good. But when you have these huge gaps, that's professional gap, although there were a lot of retailers that inverse, but it's a big gap. So I would not think about that. And then also your candles. I mean, the first disc gave you a nice giveaway that, listen, look what happened. I mean, there is no confirmation we are going up. So actually, it's a good time to short it, but I wouldn't have played it if I were you, because it's like a fast and furious. Then we went to our support. and we held that support. We had a nice bounce, went to the next resistance, and then we just collapsed. We had a big jump here, and that's when it collapsed. So I did on S&P, I did one trade. On the days like this, what I like to do, I like to tippy toe and test the waters. And it was right around 7:34 or 5. I wanted to set, just said, you know, although I've had some really good days on the down days, it has worked very well. Um, like the flash crash when it happened, we didn't have a micro. I decided to stay, you know, all the turkeys, the chemicals in my head. I'm still thinking about the Persian and all the other cookies we've had, the apple pies. It was not a really good time to really get jump in this because it was a very much event oriented. So it was the fundamentals were not very clear. So I just used the micro, the MESC, and I jumped in that. I bought 5. And my reasoning was I actually went long on this. And the thing was, I was looking for a quick, we were above, this is by the way, 233 tick bars. So we had broken above the moving average. And my thought was we will, you know, it was a very small targets I had put down. We could go test it and then have another leg down. Apparently it didn't work. So I had the 5. You can see quickly within 14 minutes. I mean, all my stops hit, so I lost money, but I kept 1. And the one was I was thinking by end of the day, it's a short day. I know these buy the dippers are going to come in and it might go back to here. So I kept 1. My risk was very limited in a sense. These are micro. So in reality, you know, on a hindsight, I would have said, my God, this would have been a great time to get in. But because I'm tippy-toeing and I just don't like to, I've learned my lessons that if I had a losing trade and I could try, but the markets were not very predictable at that time. And it was a whipsaw. So it would have been a good idea once we, you know, we break this moving average and you can see we just went down again. Oh, could be double bottom. I could go for here. It's a higher lower bottom, should be going here. But to make it short, what I did, I had 1 runner and eventually I just got out of it at right around 9:32, right around here, and I'm done. So, you know, you would say, oh, you could have held it, you know, could have made a little bit of money. No. And my reasoning at that time, of course, I had an appointment at 10:30, so I want to get there too. It was this, because I use a 5-minute linear regression channels, and this is that double bottom we just talked about. So I got out right around here. And my reasoning was, it was just basically, I didn't ask for the confirmation. I didn't get out here. I got out here because we hit that the second LRC and I'm done. And I lost, I can tell you exactly, I lost $182.50. And that was the best tuition I could make. I made money. I did a corn trade, which is a different story. It was, and had gold trade. So it was a positive day, but this was negative, but I'm glad to pay. And I didn't want to go regular, you know, E-minis, you know, you just multiply, it would have been $1,820 loss. So, but days like this, I'd rather be on the sideline anyway. If, you know, I'm not 100% focused, because if it's a very volatile and fluid environment. So anything, any news can come in. So that's one. The second one is I did it on Monday morning, early in the morning. And these are my thoughts. And this one, that was the future. A lot of you maybe don't do the futures. This one was an option trade. And my thought was, this is this Monday. And the thought was, I had told you that 47.12 has been a really big resistance. If you recall that the news about, you know, Chairman Powell came and the markets were on the move and they decided to go up. So right around this time, I think it was like 7:12 or so. I did two different accounts. So on this one, this is a TradeStation account. So I bought 5 contracts on S&P. It was, so just bear with me. This was on Monday, and I bought Wednesday's expiration, and I will explain why. Wednesday's expiration, the put at 473, and the market was, this was at the money. So S&P was at like 473, and I used at the money put, and it was Monday morning, and the markets were, so this is, yeah, so you can, at 7:12, I bought 5, and then I put my targets in, and, you know, so I had the 4 of them I got out, and the runner was at this, and I got out at 8:57. So I was in this trade for an hour and a little over an hour and a half. Okay, so the idea was right here, and this is when I decided to basically right here. So I was looking at this. This is the resistance, and you would say, it's Monday. We've had we had a professional gap up, not kind of professional, but it was a gap up Monday, which I don't play. The gaps on Monday, which eventually it was filled, by the way. Those are my thoughts. Number one, I had a daily, and the other thing was, the ticks. Although we had a big jump, that was a big day. The ticks hardly were moving, so they stayed under the 400 and eventually stayed down, and basically even like middle of the day, although the market was still up, they were just below zero. They could not just break out. And finally, by end of the day, which I'm out of my market, by the way, I mean, my it was out somewhere around here. This would have told you right here, around here, that this gap could be filled. So you could have just wait, and you could have actually filled almost this would have filled your gap. If you missed that, this would have given you, these candles would have given you, the go-ahead run. And the reason I want to share this also, these are some of my pivot points from the past. But anyway, going back to my 2 reasons I wanted to get out of, I bought the put options. Number 1 was because we read that resistance, and I did the 5 puts, and I didn't do a Monday. So, because we do have a Monday SPY options, my thought was this was a reactive, this is Monday. People, they get this Powell news out of the way, they're all happy. So this was like more of a euphoric reaction, and then the reality will take in. So because it was so high, it was, up pretty much, I decided to use the turnaround Tuesday a little early. So my idea was, this is not going to last. We're going to have a turnaround Tuesday. So basically what I did, because I was thinking of turnaround Tuesday, I bought Wednesday's option because I wasn't sure Monday we're going to collapse. All I knew is if you stay up most of the day, Tuesday there will be a good chance that you will have a turnaround. And I used options rather than futures. It was directional. I just bought puts. I didn't buy spreads. It was very defined risk, and I was okay with that. So, but that was the idea, was a turnaround Tuesday, the resistance, and basically this is, I used, when you use the Fibonacci extension. So I used from the low to the high of the day. It was similar to the time that I got in. You can see we went and hit the 200% of the extension, and we just parked right there. So needless to say, I was out somewhere around here, and so the rest, so I got out. So this was my runner, And once I was looking at the ticks, I got out here, and I think I was up 150% or whatever it was. I got out here. You can see the mark. I mean, we collapsed. So you would say, oh, that was great timing. But of course, if I would have held it, that one runner with my thought of the turnaround Tuesday, first of all, that day we went over $6. So I bought them at 148 or so. We went to 6. The following day, Tuesday, we would have hit 8. So maybe I could have used, even trailing stop would have worked here, but here I would have been out. And then, but at the end of the day, Wednesday's expiration, we were at 376. So this is the second part I have to tell you. You set your targets and you stick with them. There is no, oh, what if I would have done? Yes, I could have, if I didn't have my system of 25, 50, 100, yeah, I could have made 400% on 5 contracts. It would have been a really nice, this was a nice trade. Imagine what this would have been. But you know what? It could have been the other way. So you just have to be content with your trade. And that's the reason I want to share this with you. So that was another trade. So quickly on the next 5 minutes, just to wrap it up, on the ETF, rather than going to individual ETFs, there are times that you come across that you really want a portion of your investments to have yields, whatever portfolio you have. I thought just share with you Vanguard's, the high yielding ETFs. They're in completely different categories, but as you can see, they're very liquid. They're big. A lot of assets under management. So these are the yields. So just a food for thought for that. Stock of the week. This is when I need the Sean. Basically, I was gonna. We visited this like in the summer of last year. I think spring or beginning of summer. We were talking about that the educational services in China. As you know, there was a crampdown. The government said they're illegal. We're just going to close them down. They cannot be a for-profit after hours, after school programs. So that like the EDU, and one of them was a tall education. They were all just collapsed. So what I thought, I just want to share this with you, that you can see nothing has really happened. So the times like this, and we see the moving averages are really flat. Could there be a catalyst? And when I looked at, for instance, again, I'm using the elder indicator, you can see we had this big drop and then it broken. So we are getting green. And so it has been really basing. So the idea is, this is just to put it in with a watch list. The rumor is that the central government in China, they are actually in talks that they might approve some of these after-hour educations to come back. And they were penalized. I mean, they just collapsed. You can see, even from $90 and they're at $5 now because there's no revenues in. But such a big country, just so much respect for education. So these educational training has nothing to do with right now, they were not independent of all the exogenous news. So just a food for thought. And I will seek, if Sean's still around, I would like to have his opinion on this. But we always look for some really unusual opportunities, and this looked like an interesting story. Next 2 minutes, I thought, with what's going on, let's look at the squeezes on the top companies, the mega caps, and this is on S&P 100. These are the companies who are in the squeeze. And last but not least, believe it or not, we still have earnings, and there's some good earnings coming. You would have thought like companies like DocuSign, if this COVID is going to continue, what's going to happen? On the other hand, some of the sports companies, with what's going on with the the demand side of things and the supply um, channels, what's going on. We have Salesforce, we have Zscaler, in the iCloud. So there's some interesting coming if you want to have some of the earnings play. There's a Salesforce, CrowdStrike, DocuSign, as I mentioned, Snowflake, Dollar General, Marvel, another interesting technology company. Zscaler is a retailer store. All right. Sorry, it was a little too long. I just wanted to review again what's happening with the day we had on Friday, and just share some insight, some personal experience stories with you. With that in mind, I'm gonna go ahead and stop recording.